Hello, everyone. Welcome to the Agoric Pillar Series. I am Roland Grouse, Product Manager at Agoric, and this is our first in a series of monthly presentations that will go over technical topics or market-based topics that Agoric is either interested in or working on. And today, I'm really happy to present Bill Tella, resident economist at Agoric, who's going to be talking about stablecoin economics.
Thanks, Roland. As Roland said, my name's Bill Tella. I'm a co-founder and economist at Agoric, and I wanted to talk today about stablecoin economics. In particular, just wanted to give sort of a high-level overview of what stablecoins are, the role we see them that they play in fueling a vibrant on-chain economy, and the role as a fundamental DeFi primitive that's really helped enable this Cambrian explosion of DeFi protocols that we've seen in recent months. The idea is to give just a high-level overview, not very technical, but wanted to give a sense of how we here at Agoric are thinking about stablecoins. So what is a stablecoin? Essentially, it's a digital asset that tries to maintain price parity with another asset. Typically, this will be pegged one-to-one with the US dollar, US dollar being, at least for the time being, the global reserve currency. But it could be something else. You could peg to a yen or a euro or a basket of currency or even the price of gold. The essential challenge with all of these is, how do you balance money supply with money demand? Where money supply is something you typically have some control over, money demand is more out of your control. Being cryptocurrencies, of course, stable coins are quite new, but we've already seen tremendous growth with over 22 billion market cap in stable coins. And as you can see from this chart, it's really grown tremendously over the last several months. What's not visible in this chart, though, is that there's lots of different types of stable coins. Often categorized according to the stability mechanism that they use. You often see them categorized in terms of off-chain collateralized stablecoins such as USDC or Tethers and others. And with off-chain collateralized, you actually bring dollars to a financial institution, deposit the dollars with the financial institution, which then issues you a digital representation of that dollar that you can then use on chain. And at some later date, you can exchange that digital dollar back for real dollars. Advantage of this is there's a nice straight connection, clear connection between the dollars that are deposited and the digital representation of that dollar on chain. The disadvantage, of course, is that you're relying on this financial institution to custody and control the collateral. An alternative is on-chain collateralized, where instead of holding dollars off-chain, you actually use crypto assets as collateral. These can be held on-chain in smart contracts atop of decentralized platforms, thus avoiding the problem of having a single trusted third party who's in control of the collateral. MakerDAO is the best known of these. MakerDAO has issues DAI stablecoin on top of Ethereum, which recently surpassed over 1 billion DAI issued. There's also this third category of algorithmic stablecoins that rely less on collateral or perhaps not at all, and use various schemes to algorithmically adjust money supply and money demand. Ampleforth is an example here where they will periodically adjust the supply of tokens in users' wallets based on the overall supply and demand conditions. Now, there are lots of different designs here, but rather than go into all the different variations of different stablecoin mechanisms, I wanted to focus on a different distinction, what I call global versus local stablecoins. And by this, I mean many stablecoins, when you often talk with sort of grandiose ambitions of being a global currency or at least a global means of payment, And these are, go across the board. You have the off-chain collateral that we've already talked about, such as Tether and USDC, but there's others, and this would also include things like JPM coin and Libra. There's the various crypto that we've talked about, Ample and DAI, but there's many more projects in this space. And we're also beginning to hear about central bank digital currencies. There's a lot of discussion and some experience going on for central bank digital currencies. And of course, we shouldn't forget Bitcoin. From Bitcoin's perspective, it's the dollar that's volatile and not vice versa. But I think this focus on global currencies and global means of payments can be misleading. And what we want to focus on here is what I want to call local stable coins. And by local stablecoin, I mean a local currency that facilitates on-chain commerce and finance, that allows you to easily trade and exchange digital assets and complex financial instruments created on top of those digital assets. And for this local stablecoin to function well, it needs to have the serve the functions of money. So it needs to be a medium of exchange. It's commonly accepted in exchange for the goods and services on the chain. It's a unit of account, helping you to facilitate economic calculation, so you easily compare prices both on-chain and off-chain, as well as easily compare rates of return on various investments. And it needs to be a store of value. And what economists typically mean by store of value is it has stable purchasing power. This is, of course, what stable coins are after, is how you can have a medium exchange, unit of account, and store of value wrapped into one. Now, this notion of having currency on a platform for exchange of digital assets and goods and services is nothing new. We've seen this in games and virtual worlds. This dates back even to the first virtual world back in the 80s, where Lucasfilm's Habitat had a currency called the token, which was used for a variety of purposes, creating this full-fledged economy on the system for exchanging digital goods and digital services. We see smart contract platforms as sort of an extension of this, but where they differ from virtual worlds is that they're much more open to and embedded in the global economy. So we like to think of smart contract platforms as being essentially small open economies. Small in this sense means small relative to the size of the overall global economy. Open means that the economy is open to the global economy, embedded in and exchanges with the global economy, as well as with economic activity on other blockchains. So if we view smart contract platforms as sort of open economies, we can ask the question, well, what's the best monetary policy for this? And we can look at the real world, and there are several different monetary policy choices we can look at. One is central banks, which is quite common, where each economy issues their own currency. At sort of the other extreme, you have dollarization, where countries such as Panama or Ecuador will use an external currency, often the dollar, as their local currency. And then there's a currency board, which is sort of a compromise between the two, where a currency board issues its own currency, but that currency is backed one-to-one with an external currency. Central banks, of course, are widely used. They have give you flexibility, although that flexibility is both good and bad. There's a long-running debate in economics between the merits of rules versus discretion, with many arguing that rule-based systems are better for long-term economic growth. A challenge there is, though, is how do you credibly commit to following the rule? This applies to exchange rate policy as well, where it's difficult for central banks to credibly commit to defending a pegged exchange rate. There's this notion of international monetary trilemma, where your central banks are basically between fixed exchange rate, free capital flows, and independent monetary policy, they can only pick two. Often, this discretion can lead to problems, to inflation or devaluations, and that has led some countries to go sort of the opposite extreme with dollarization, where you have no discretion because you're using an external currency. This can be costly because you need access to the external currency for local use. And there's a certain loss of monetary sovereignty where you're subject to the monetary policy of the external currency you're using. You're basically betting that that policy is better than what your central bank could do. As I mentioned, currency boards sort of fit in as a intermediate step between these two extremes. Probably been used periodically throughout history. Perhaps the best known is the Hong Kong dollar, which is issued by the Hong Kong Currency Board. And it's much more rule-based in the sense that you issue your own currency, but it is backed 100% by an external currency, and it's fully convertible into that external currency. Reserves are usually, as I said, 100% or a little bit more for an extra buffer. And there's the ability to get some certain degree of monetary sovereignty where you can capture seigniorage revenue in the form of interest on the reserves, although not from inflating the currency. When you look at on-chain stablecoins, so on-chain collateralized stablecoins, I think they're very similar to currency boards, where they attempt to hold 100% reserve of the stablecoins issued, but there's a challenge that they face that currency boards don't, and that's that you can't actually hold dollars on chain. What you can do is you have to hold some sort of digital asset on chain, and either it's a digital representation of the dollar that gets you back to the on-chain, sort of the off-chain collateralized asset, or you hold a crypto asset where what you're trying to do is maintain the reserve at 100% of the dollar value of that asset. So with MakerDAO in the early days, they held ETH as the currency in reserve, but committed to holding 100%, or in the case of the buffer, 150% of the value of the dollar value of ETH in reserve for every DAI issued. This creates a couple of challenges on this level of indirection. One is you need an oracle, either off-chain or on-chain, that gives you a way to determine what the dollar value of the collateral is. It also leads to the issue of liquidation. What happens when the value falls below 100%? Well, you need to commit to liquidating the collateral in order to buy back the currency. What's interesting is that even though currency boards don't face the same challenge of indirection, we have seen this in existence in derivative markets. This structure is very similar to the way derivative markets have margined derivatives where margins are the collateral that's being held, and the value of the collateral needed changes over time. So what I wanted to emphasize here is that when we look at what's been happening in the DeFi space, that DAI has really helped fuel the DeFi explosion. When Maker came out with a stablecoin, the DAI, it has really allowed it to be plugged into a variety of different DeFi protocols and given you a standard unit account for comparing the rates of returns across the different protocols. So here, this is just a little snapshot of one instance where the demand for DAI surges, because it can be used easily in Compound. So to emphasize again, what we see the real value of stablecoins, at least in the short run, is not so much as being a global currency or global means of payments, but is really being able to fuel on-chain economic growth. It's, as this quote says, money makes the world go round, but it does so by greasing the wheels of commerce and finance. We at Agoric are building a level 1 chain on top of Cosmos Tendermint. It includes a smart contract framework that we're building out called Zoe that enables a whole slew of different DeFi primitives and components to be built on top of that. In conjunction with that, we're trying to build an economy that enables this rapid economic growth on top of it. So Zoe and ERTP give us an institutional framework for enforcing property rights and contracts on chain. We have a proof of stake system that provides consensus security, execution and rewards for validators, giving us predictable economics for executing contracts on our platform. And we're integrating stablecoin and dapps into our economy in order to give us a stable, uniform transactions on the chain. So please follow us to find out. We'll have more information about the particulars of our implementation of the economy and our stablecoin in the future. But in the meantime, please check out our code. We have documentation online. You can go to our GitHub, look at our contract examples, and please come join us in building out this economy. Thank you very much.
All right, thank you, Bill. And as Bill said, a lot more is coming, and in the Pillar series in particular, we'll be doing presentations once a month or so, and talking about more aspects both of our economy, but then technical and conceptual pieces that we are working through. So Bill, I appreciate it, and I'm gonna take you down now. If anyone has questions, feel free to throw them in chat, or we're always available in Discord. So please join our Discord, engage with us there. Happy to bring in economists, happy to bring in developers to chat. So really appreciate it, and we will see you all soon.